Are you investing in the international markets? When it comes to the US markets, we have seen dominance over the last 2 years, but it seems like 2025 that might not be the case for the benchmark, the S&P 500. So far this year, it's really underperforming. We have seen a 10% correction, which came off the all-time high, and it is staying, it seems like, in correction territory, even looking at the losses that we've seen yesterday. Now, due to this, looking at recent weeks, the weaker economic data, concerns about rising inflation, possibly a recession, and then looking at President Donald Trump and what they're doing with multiple trade wars with a lot of different partners have really stalled the market. Now, last week, S&P 500 was into that correction territory, and it seems to be playing around with it right now. But what if we could look at a broader picture and taking it out of the S&P 500 and moving it into the broader international market? So in today's video, we're going to be looking at 3 Vanguard ETFs that have left the S&P 500 in the dust as far as dividend yields and performance in 2025. Now, the first one we look at is the Vanguard International High Dividend Yield ETF. This has a yield of 4.53. When I even think of the SCHD at a 3.6, when I think of the VYM, this absolutely crushes it in terms of yield. Now, when we look at this, it tracks large cap stocks in emerging developing markets outside of the US that have a higher dividend yield on average. Now, the S&P 500 has fell nearly 4% year to date. The VYIM is up 11% already this year. So incredible performance out of this. ETF also has an attractive dividend yield of that 4.5%. Over 44% of the funds are invested in Europe, where a lot of people are moving their money. We know Warren Buffett has moved a lot of it to Japan, 26% in the Pacific region, 21% in the emerging markets. In terms of sectors, 39% of this is in the financial industry. So we know traditionally financial industry, number one, they pay a decent dividend yield. Number two, they have a lot of stability. We don't have a lot of banks failing, even though it does happen in time to time. We do not see a really big part of them. Now, following the Great Recession, 2008, 2009, when we see in the housing market, many parts of the world struggled to really restart the economy. That is where central banks, including the US, lowered rates. We've seen the really central bank of Europe go to a lower benchmark of near zero, like what we did for COVID. And overall, it was kind of crazy with the amount of lending they were doing because money was very, very cheap. Now, the second one we look at is the Vanguard Global ex-US Real Estate ETF. This has a 3.97% yield, and this ticker symbol is VNQI, seeks to track the international real estate stocks and some of the real estate or the real estate investment trust or the REITs. Now, when we get done with all 3 of these guys, I want to go through, I want to do a comparison for them as well. So the REITs hold corporate structure buildings that have certain tax advantages. So this is a REIT that is formatted in really building into and buying into corporate structures. They require a 90% payout of annual taxable income through dividends, must reinvest 75% of the assets into real estate or holding it in cash, and receive 75% of gross income from that real estate, including rent, mortgage interest, property financing, or real estate sales. This has underperformed the VYMI, the one that we just looked at, but it's still up about 4%. So we're not seeing it at that negative correction territory when we start looking at this. Now, real estate, foreign markets, whether it's China, whether it's, different sectors in Europe, there's a lot of different places that are having a really big challenge when it comes to making housing affordable or trying to keep housing affordable in general. And the final one we look at is the Vanguard European Stock Index Fund, which is a 3.02% yield. As the name suggests, this is the small, mid, large cap that holds the majority of the European market. So again, very similar to what we have with the S&P 500. This is the European variation of it, holding all of those cap stocks that they do have in Europe. As mentioned above, attractive valuations in Europe. We're starting to see a lot of growth in there. And this is really crushing the S&P 500. Right now, S&P 500 since January of 25, down about 4%. But looking at the Vanguard European Stock Index, the VGK, it is up about 16% so far this year, which is crazy. And a lot of people, again, the inflation evaluations that we see in the US, the economic really turmoil that we're seeing as well is causing a lot of people to take that money and move it over to Europe, moving it off the shore. Like I said earlier, that's exactly what Warren Buffett has done. I'm investing a lot of money in Japan, in European markets. The ETF has surged 15% up this year, which is kind of crazy as Trump is trying to bring everything back into the United States market. We're seeing a lot of pullback or a lot of growth outside of the market. So let's go ahead. I want to hop over. I want to do kind of the side-by-side comparison of these two so you can take a look and see exactly what we're looking at. So right here to ETF.com, I'm going to go through and I want to break this down. So looking at the VYMI, the VNQI, and the VGK. Now, these are three Vanguard funds that we're talking about. And looking at the growth and looking overall, valuation 76, 41, and 73 on the last trade. So overall, not super expensive. We're not talking, hundreds or thousands of dollars to get into these funds. And the underlying principle is important because when you look at the holdings, so when you think of diversification, the VYMI has almost 1,500 holdings. The VNQI has 675, and then the VGK has 1,255. So again, if you're looking for diversification, if you're looking for a lot of different markets, it seems like the two on the right and the left are going to be the most diversified with over 1,000 holdings within there. Expense ratios pretty similar. So when you think of the international 0.17, so a little bit higher than we see of the 0.06 of like our SCHD. Expense ratio on the REIT 0.12, so still pretty good. And then that 0.06 is right here in that Vanguard European ETF. So again, very similar to what we see with like an S&P 500 fund is what it's growing in. Even looking at how much is being traded on a daily basis, 38 million, 11 million, 260 million. Again, thinking of something that is much larger, almost like a VTI that we see in the US. So performance, this is where it kind of gets interesting. This is going back all the way to March 20th of 24. So we're looking at the 12-month running average on how this is performing and really breaking this down a little bit further. 1 month, we can see it is positive across the board. Majority of the US markets is negative. They are negative as we're sitting right now. But even looking at the 3 months, the VYMI is at 13.42%. That is a really, really high growth rate over the last 3 months. We're seeing a lot when it comes to the dividend production. 5.18 rate here in the VNIQ or the QI. And then the VGK is at 15.55. And again, very similar when we look at the year to date. But then we start looking a little bit back, a little bit further, looking at the 1 year. These are just kind of the indicators. Now, of course, the past performance is not indicative to anything in the future. So definitely do your own research when it comes to these. But looking at a 16% return in a year, even over here in the Europe markets, about a 14%. But what's interesting is breaking out the 5 years. We're at 18.59 over the last 5 years, 18.29 again over the last 5 years. The real estate 5.10, which me personally, I do not own and I do not invest in any REITs. And I also do not invest in the international markets just because I am not as familiar with them as I am with the US markets. Now, the top 10 holdings, this is a little bit of a different breakdown because this is going to show you a lot of the companies that you know and trust here, not knowing that they were not US-based companies. When you look at like Nestle, when you look at like HSBC, Toyota, Shell, Siemens, a lot of these seem like they would be or they are here. And we do see an incredible amount of staple items in the United States, because even looking over here on our right side, again, you have Nestle in there, you have HSBC, you have Shell. So there is quite a bit of overlap. And the middle one is the REITs. Now, holding a majority of the funds right there, 6% in the US dollar. And you'll also notice that some of these do hold 1.5% in the US dollar. That gives them a really good operating, the ability to invest if needed or when needed, or if they do see a drop. This also in here, Toyota's in here. Again, a couple others that I really didn't know that operated or are headquartered outside of the United States. And again, the REITs, I feel like maybe that's not the best place to put the money, but the VYMI and the VGK could definitely be some investments if you wanted to get outside of the United States. Now, like we had said earlier, when it comes to finances, a majority of these are financial. The VNQI, which is the real estate REIT, is 87% in the financial sector. For me, that is not diversified at all. Maybe if you had a small percentage, like 5-7% into that ETF itself, just because it is so heavily vetted into that finance space, where if there was an issue with finance, it could be a big issue for this ETF. Now, looking at the VYMI, you can see 40% in finances. I'm not too worried about that as far as finances, 40% versus 87. And overall, looking at the 40%, Financial companies do pay dividends and have paid dividends. We know it looking at Chase, Bank of America, Wells Fargo, all of those companies that are in the financial sector that pay dividends like clockwork on a regular basis. Now, when we start looking at what else they're holding, not much. I mean, we have a couple percent kind of here and there, and it breaks down the segmentation a little bit further here, where finance, again, 40%, 87% here, 23% when it comes to the S&P 500 or the Vanguard version of that S&P 500. But consumer, non-durables, health, technology, doesn't seem like there's a massive part in tech. So where, again, a lot of the U.S. industry, and I kind of think the comparison of looking at, the technology side of it and how much of the S&P 500 is driven by really technology, how much is driven by, when you look at your Apples, your Microsoft, your Google, those large tech companies that are absolutely driving the performance that we see within that S&P 500. It's very, very interesting to see. Now, distribution rate 4.3999, but 11.789 P&E ratio. So a very low P&E ratio, honestly, much higher for the REIT, much higher for that fund, the European ETF itself. But all right, guys, so that's going to do it for today's video. Let me know in the comments. I just wanted to explore and kind of get to know some of these ETFs that we see outside of the US market. So let me know in the comments what you guys think. And as always, thank you guys for watching.